Welcome back, Adam here. Today I'm looking at how different investments are taxed here in the UK. This is a fairly broad subject as investments can take many different forms and the type of investment can impact how much tax you pay. So I'm going to focus on some of the most popular investment types and I'll look at all the different headline taxes that might apply, which will make sure you're covered, whether you're simply holding cash in an interest-paying bank account, you own an investment property, shares and securities, or even cryptocurrency. Now, before I get into the first investment type, I would just point out that if you hold any investments in an ISA, which is an individual savings account, then this acts as a shield for the investment and it protects it from all of the taxes that will be mentioned, which means no tax would be payable. Currently though, from the investments I'm about to cover, you're only able to hold cash and shares in an ISA, and you cannot use an ISA to shield property or cryptocurrency from tax. So let's start with the basics. Cash. If you're holding cash in a bank account, then you may well be receiving interest payments which may be subject to tax. Now, you might be thinking that you've never had to pay tax on your bank interest before, and you might well be right, but typically that's been because interest rates have been so low for such a long period of time, and that's meant that most people weren't generating enough interest income to fall within the scope of tax. And then prior to that, UK bank interest was actually paid net of basic rate tax. So it may have been that your tax liability was already being settled before you received the interest payment. Now that UK bank interest is paid gross without any tax being deducted and interest rates are higher, more people are subject to tax on their interest income. Interest income can be covered by a personal allowance. So if you have any personal allowance remaining, this can be offset and then no tax would be payable on the covered amount. You then have a personal savings allowance, which is £1,000 for basic rate taxpayers and £500 for higher rate taxpayers. Any bank interest covered by this allowance is also tax-free. And then finally, if you earn between £12,570 and £17,570, you may also benefit from the starting rate for savers, which can allow for an additional £5,000 of tax-free interest income for the lowest earners. Although when they say lowest earners, what is actually meant is retirees who have low incomes but substantial savings. Low earners at the start of their careers are very unlikely to have enough savings to generate that kind of bank interest. Next up, let's look at investments in shares and securities, and there are two types of income that you'll need to consider here. The first is dividend income. When you own a share in a company, if that company distributes profits to shareholders, it will usually do so in the form of a dividend, which is essentially a cash payment to the shareholder. Dividend income can also be covered by the personal allowance, so if you have any remaining allowance, this can be offset. Individuals also benefit from a dividend allowance, which in the 24-25 tax year sits at £500, although this has been gradually decreasing over the past few years. Anything in excess of this would then be subject to tax. However, there are separate tax rates which are used specifically for dividend income, which increase as you move up through the tax bands. These rates tend to be slightly lower than the usual income tax rates of 20, 40 and 45%. This is because in order to pay a dividend, a company has to make a profit, and that profit is subject to corporation tax. So this income was taxed once already in the hands of the company that paid it, and then again when the shareholder receives it, hence the slightly lower rates. The second form of income you might receive from your investments in shares and securities would be capital gains. This is essentially where your asset appreciates in value, so it's worth more than what you paid for it. However, you're not taxed until the gain is crystallized, which is usually deemed to be when it's disposed of. A capital gain can be calculated as the disposal proceeds, less any cost to sell, like transaction fees, less the cost of acquisition, which is the amount that you paid for the asset, less any cost you incurred to to make improvements to the asset, and finally, less any cost of acquiring the asset. Again, for shares and securities, that's likely to be the transaction fees or stamp duty land tax. Once you've calculated your capital gain on a disposed asset, such as shares and securities, you would then need to consider if capital gains tax would be payable. The main rates of capital gains tax are 18 and 24%, and these are the rates that would apply to the disposal of shares and securities. Before calculating how much tax you need to pay, you'll need to combine all of your capital gains and losses from a tax year into one single figure, deduct the tax-free allowance for capital gains from your total taxable gain. This allowance is currently £3,000. You'll also need to calculate how much taxable income you had during the tax year, excluding your capital gains. If you have remaining basic rate band, then the gain would be taxed at 18%. For any amount that takes you above the basic rate band, the 24% rate would be applied. The next investment to consider would be property. Again, investing in property can result in multiple taxes being applied, as there are potentially multiple income sources. Firstly, rental income, which is taxed under normal income tax rules, meaning any remaining personal allowance can be offset. Individuals then benefit from a tax-free property allowance of £1,000, and anything in excess of this would then be taxed at 20, 40 or 45%. Any gain on the disposal of a property would also be subject to the capital gains rules previously covered for shares and securities. The only difference with property is that when you're calculating the gain, improvement costs are far more likely to be included, as properties are often extended or refurbished. In the past, there were different rates of capital gains tax for residential property disposals. However, the rates were aligned from the 30th of October 2024. And the final investment type that I'm going to briefly consider today is the buying and selling of cryptocurrency. Now, I say briefly because cryptocurrency, like property, can generate income from a variety of different sources, but for the average investor, these won't often apply. If you did want to know more though, HMRC published their crypto asset manual, which delves into the tax treatment of all these different crypto incomes, of which there are many. What is very common though is the buying and selling of different cryptocurrencies, which for the most part will be taxed in the same way as someone who buys and sells shares and securities, which means it's capital gains tax that would apply. A capital gains allowance of £3,000 is available, and then remaining gains are taxed at 18 or 24%, depending on whether you have any basic rate band left after considering your other taxable income. One major pitfall that many investors aren't aware of is the swapping one token for another and using cryptocurrencies to make a purchase would be considered disposals, which means you would need to calculate if you've made a gain each time you do either of these things, and you would potentially need to pay tax too. That was UK tax on savings and investments. I hope you found that useful. Thank you for watching. See you next time.